Have you ever noticed how the stock market behaves like a tightly stretched rubber band? When you pull it too far in one direction, it desperately wants to snap back to the center. For decades, the smartest minds on Wall Street have quietly exploited this simple, natural law of human emotion to pull consistent profits out of the market, even during chaotic times. But here is the catch. Most everyday investors do the exact opposite. They panic and sell at the worst possible moment, right before the market springs back up. Today, we're going to look at a highly respected, mathematically grounded method designed to do one thing. Identify the exact moment a falling stock is about to snap back, allowing you to buy the panic and sell the relief. If you have ever wondered if there is a systematic way to buy low and sell high without relying on guesswork or gut feelings, you are in the right place. To understand why this works, we need to look at the philosophy of mean reversion, popularized by a legendary trader named Larry Connors. He realized that in a strong, healthy market, short-term drops are rarely the start of a total collapse. Instead, they are usually just temporary pauses, moments where buyers catch their breath before pushing prices higher. His creation, the RSI-2 strategy, was designed to capture these brief, high-probability pullbacks. The strategy doesn't try to predict the next multi-year bull market or find the next hot tech startup. Instead, it looks for quick, 3 to 5 day opportunities where fear has temporarily pushed a major asset down too far, setting up a highly predictable bounce. By focusing on these short-term distortions, it attempts to achieve steady gains with a remarkably high win rate, without holding on to assets during long, painful bear markets. It is a philosophy built on exploiting human fear rather than trying to predict the future. At the heart of this system is a classic technical tool, but with a radical twist. Most traders use a standard 14-day window to measure whether an asset is overbought or oversold. But our developer realized that 14 days is far too slow for fast-moving markets. By the time a 14-day indicator tells you a stock is cheap, the bounce has already happened, and you have missed the entire move. His solution was to shrink the window down to just 2 days. A 2-period window is incredibly sensitive. It acts like a high-precision magnifying glass, instantly capturing extreme short-term panic. Statistically, when we analyze decades of historical data on the S&P 500, we find a fascinating anomaly. When this ultra-short indicator drops to extreme lows, the probability of the market rising over the next 5 days increases dramatically. It is a genuine statistical edge, proven by historical data, showing that short-term panic is almost always a buying opportunity in a broader uptrend. So, how exactly do we trade this? The rules of the RSI-2 strategy are elegant and strict, designed to remove all human emotion from the equation. First, we establish the long-term trend. We only buy if the price is trading above its 200-day moving average. This simple rule acts as our safety net, ensuring we never buy a stock that is in a structural death spiral. Second, we wait for a short-term panic. We buy only when the 2-day indicator drops below a critical threshold, typically a value of 10 or even 5 for more conservative entries. This signals that short-term selling pressure is completely exhausted and the rubber band is fully stretched. Finally, we need a clear exit rule. We don't hold on forever. We sell as soon as the price bounces back and the 2-day indicator crosses above 70, or when the price closes above a short-term moving average. This ensures we lock in our profits quickly and return to the safety of cash before the next market swing occurs. To see if this theory actually holds up in the real world, we put it to the ultimate test. We set up a rigorous historical simulation spanning a full decade, from July 29, 2016, all the way to July 29, 2026. This 10-year testing window is incredibly robust. It includes the massive bull market of the late 2010s, the unprecedented pandemic crash of 2020, the aggressive interest rate hikes and inflation fears of 2022, and the subsequent technology-driven recovery. We chose the ultimate benchmark for our test, the SPDR S&P 500 ETF, ticker symbol SPY, which tracks the 500 largest publicly traded companies in the United States. In our simulation, we applied the exact mathematical rules of the strategy with no hindsight bias, executing trades automatically to see if this short-term trading system could actually outperform a simple, long-term buy-and-hold strategy under real-world market conditions. The results of our 10-year simulation are now in, and they paint a fascinating picture of how short-term trading compares to long-term investing. Over this 10 period, the RSI-2 strategy executed a total of 68 trades. What is immediately striking is the efficiency of the system. Out of all these trades, the strategy achieved an extraordinary win rate of 47.1%. This means the vast majority of our entries successfully captured a short-term bounce, validating the core statistical edge of the system. In terms of absolute performance, the strategy generated a total return of plus 96.0%, which translates to an annual compound growth rate, or CAGR, of plus 7.0%. To put these numbers into context, we must compare them directly to our benchmark. Over the exact same period, simply buying and holding SPY delivered a total return of plus 300.6%, with an annual compound growth rate of plus 14.9%. These numbers reveal the true trade-off between active trading and passive investing. But total return is only half the story. To truly judge a trading system, we have to look at the risk we had to take to achieve those returns. This is where we look at the maximum drawdown, which measures the largest peak-to-trough decline in our account value. During this volatile decade, buy-and-hold investors had to endure terrifying drops, testing the resolve of even the most disciplined traders. In contrast, the RSI-2 strategy experienced a maximum drawdown of just minus 6.8%. Because the strategy spends a significant amount of time in cash, waiting patiently for the perfect setup, it shields your capital from the worst of major market crashes. When the market is in a sustained downtrend or experiencing extreme volatility, the strategy simply stands aside, preserving your mental peace and your trading capital while others are panicking. It proves that sometimes the best position to hold in the market is cash. However, at Backtested Hub, we believe in complete transparency, and no trading strategy is perfect. The RSI-2 strategy has several critical limitations that you must understand before risking real money. First, because it is a highly active strategy, it generates a large number of trades, which can lead to significant transaction costs and tax obligations that eat into your profits. Second, there is the issue of cash drag. Because you are sitting in cash for long periods waiting for a signal, you miss out on the compounding power of dividends and long-term market uptrends. Finally, we must address the psychological hurdle. Buying when the market is crashing and everyone else is panicked is incredibly difficult. It goes against every human instinct. When the indicator drops below 5, the news headlines will likely be terrifying, and entering a trade will require immense discipline. If you hesitate or let fear take over, you will miss the entry entirely, destroying the mathematical edge of the system. Ultimately, the RSI-2 strategy by Larry Connors proves that short-term mean reversion is a powerful, statistically valid concept. It offers a high win rate and exceptional protection against major market crashes, making it an excellent tool for risk-averse traders who prefer steady, frequent wins over long-term volatility. However, for long-term wealth accumulation, the simple discipline of buying and holding a broad market index like SPY remains incredibly hard to beat, especially when you factor in taxes, fees, and the simplicity of execution. Which approach fits your personal trading style and psychology? Let us know in the comments below. If you found this objective, data-driven analysis valuable, please hit the like button, subscribe to Backtested Hub, and turn on notifications so you never miss our next deep dive into the world's most famous trading strategies. Thank you for watching, and we will see you in the next backtest.